The question is, who pays for it? Who's liable when something breaks? And whether charging for APIs is cost recovery or a competitive strategy. And are those fees a fair way to fund infrastructure, or is it a toll that could make pay by bank less competitive with cards? So tonight we're using an Oxford-style debate, which I heard on a podcast a few months ago. I thought it was pretty cool. So we have a single resolution. You, the whole audience, will vote before and after the discussion to see which side changed the most minds. So do you want to pop up the poll if you have it, Nikki or Bill? So banks, the resolution is banks should be allowed to charge for API access to consumer financial data. Yes, no, or undecided.
How about somewhere in the middle?
Well, that's undecided.
Okay.
Okay. I guess we can leave it open. I'll keep talking. You're going to hear banks, obviously, arguments from the bank perspective, from the fintech perspective, because we have an aggregator on, and some regulatory context from a former CFPB leader. And we'll go to audience Q&A. So, start thinking about your questions, and then we'll have our second vote. And then after the formal event, we'll have small group networking. We break everybody up into groups of like 5 for 10 or 15 minutes, and you can meet the other attendees. The way we have this set up, you can actually take yourself off mute and talk, or if you prefer, you can put your questions in the Q&A window and we'll weave those into the discussion. If you'd like to connect with others, you can put your name and LinkedIn information into the chat. I think pretty much everyone's already done this. Turn off your video and mute your microphone so we don't get distractions. I'd like to thank PayCLT. I'm sure some of them are on. So that's our sister organization in Charlotte. They partnered with us on this event. And our sponsor, Lithic, because we need sponsors to keep these NYPAY viable. So, and also keep out an eye for upcoming NYPAY programs. We have events planned on authorized push payments fraud, agentic commerce, stablecoin, scams, and more coming. By the way, if your company is interested in sponsoring NYPAY or an event, please contact us. It's only because we get sponsors that we're able to continue these events like we have for the past 15 years. And we're also interested, if you're interested, we're happy to have volunteers on our events committee. So that we'll get started. We've just cast our first vote. And let's see, there's a lot of undecided people. That's interesting. Let me just capture that. Okay. So this is what we're up against, panelists. Okay, I'm going to ask each panelist, I'm going to give you their name and title, and then they're going to make opening statements. So on the pro-bank perspective, we have Nick Rosenberg, who's an EVP and Chief Business Development Partner at Metropolitan Commercial Bank, and Christiane Gennaro, who is NYPAY board member. And then we have, on the fintech perspective, against monetization, I assume, Mark Beckhofer, who's the co-founder and CCO of Quilt, and maybe he'll tell us a little bit about Quilt. And then from the policy context, we have Gary Stein. A lot of you probably seen him on television. So I feel like I'm meeting a celebrity. He's the managing director of North American Payments Leadership at Accenture, but formerly one of the original, I believe, CFPB officials. So I'll ask Nick, you want to start? Make your opening statement.
Sure. My name is Nick. My background is electrical engineering. I'm a chartered engineer, so more on the technology side. But I've been a Metropolitan Commercial Bank for 25 years. And I do believe that fintechs bring innovation and competition to financial industry. It's welcome. I believe that open banking is a win for consumers. But I also believe there's a cost associated with this technology, and we need to be reasonable when allocating the cost and burden of the implementation. So furthermore, I don't believe that regulators should be involved in setting market pricing. I think we should give the market a chance to stabilize reasonable pricing to access the data. And that doesn't mean that consumers need to pay for everything, but if a fintech is monetizing a financial product they're offering, then perhaps they can pay for the access to the data they need rather than expecting the bank to subsidize it.
Okay, Christiane, you're on mute.
I just realized it'd be hard to bring that same energy from our dinner debate, Deb, if I'm on mute. But anyway, now that I'm off, I will try. And I'd like to say, first of all, I think that I don't think anybody on the panel, right, would actually disagree about innovation and competition and consumers' ability to access their information. But I do think even the way that it's kind of stated in the debate here, consumers should have access to their data. I don't think many people really understand that access to the data doesn't just mean, kind of transmitting the information and letting someone confirm it. It also means initiating payments. There's risk involved if the bank that is providing the data allows a transaction to happen and there's something fraudulent in nature, that bank bears it. So I think kind of the title of just, consumers accessing their own data is maybe a little bit more benign or really kind of underplays, the responsibility, if you will, of the bank that has the data. And so my argument is that, of course, it costs to maintain the data to provide safe and secure access. And the recipients of the data, it's not just me getting my own information for my own use, right? I'm actually providing it, even if I'm authorizing the third party, that third party in some way is making money off of my giving them access to my data, right? It's not just kind of a neutral situation. So I do believe firmly that the information should be available, but I think it's reasonable that there's a cost for it. Whether the market can regulate or kind of reach that cost itself in a fair way, or whether ultimately there might have to be parameters on it in terms of cost recovery, et cetera, I think only the future will tell us. But I do think that banks should be able to recoup at least the cost of providing the data, if not make a little margin on it. So that's my point of view.
And Mark.
Everyone, I'm Mark. I'm one of the co-founders of Quilt. We have a very unique perspective in that we are not an aggregator ourselves, but we sit as an abstraction layer above the open banking aggregators. We essentially route traffic based on conversion rates so that there's a maximum chance that people find their bank and can actually get their data, and then we normalize it. This gives us a unique perspective into not only how each aggregator works, but the vast majority of use cases across all of them. It's everything from pay by bank to a lot of cash flow based underwriting, other automated accounting services, you name it. It really runs a full spread of different use cases. The issues I see is that the prices being applied, at least as we're seeing them come out in the market, are significantly higher than the costs of hosting. They're looking more like a barrier or a moat around the interchange model. And they're being applied to not just what we would call pay by bank. It's anything that involves money movement. So, for instance, a consumer who has no credit can access an earned wage access product via fintech using cash flow based underwriting. But because there's a money movement involved in transferring that loan to that consumer, the Chase agreements are essentially leveling a 10x price on that use case versus a PFM just accessing the transactions data. And so the way it's being scoped currently, I see that the greatest harm is going to come to the use cases where the greatest good is being done, essentially. Outside of that, you'll always hear the banks bill this as a cost center. The reality is that standing up these APIs is an incredible marketing insight for the banks, where they're spending today tremendous marketing budgets on consulting agencies to put them together massive models on how to sell to their customers and cross-sell their products. These APIs actually tell the bank who is using their data and how. And so they can see where their customers are being targeted, where their customers are shopping outside of their walls, and what they're self-serving into. That is a tremendous amount of insight that anyone would pay a massive amount of money for. And these APIs enable that at the end of the day.
That's really interesting. So it's applying it to any money movement, not just payments. That's interesting.
Correct.
Okay, Gary, you can give us a neutral or non-neutral overview of the regulatory landscape, because I think
I'm going to try not to put my thumb on the scale, but
And tell us about the
One
lawsuit and the,
one friend of mine said I was the most opinionated man he ever met. So this might be hard for me, but
okay.
in any event, just to provide a little backdrop, I think a lot of people are probably aware of this, but it is interesting that we've gotten to this point. When the CFPB was created and the mortgage crisis was attempted to be cleaned up through the Dodd-Frank Act, there was a provision in there, Section 1033, that said consumers shall have access to their account information in machine readable format. And there's really not much more to it than that. It didn't say a lot more. And I have a theory that I think a large driver of it was an expectation that if consumers had portability of their account history and information, they could switch institutions willy-nilly, and that would drive more competitive pricing. This is a payments organization, so we don't need to lecture each other about the fact that payments were not instantaneous in 2010. And so it doesn't just work that you can pick up and move your account that easily if you're transacting. But over that time, and for 10 years prior to that, this cottage industry had emerged by which fintechs enabled through aggregators were enabling consumers and businesses to use their information for a lot of the use cases that Nick, Christiane, and Mark talked about. And so at the Bureau, when I was there, as we approached this, first of all, we had a lot of other statutory rulemakings that we had to get done. So this isn't one that we were going to try to do early. And then we saw this developing market here. And so the Bureau has gone through a pretty protracted rulemaking process that started with an RFI, consumer protection principles, and ANPR, which is when I checked out. They finalized the rule about a year ago. And then it's been an amazing soap opera since, with the change in leadership at the Bureau getting sued the day the rule was published by two banking organizations and a couple of banks, and now a new administration coming in saying, well, we actually want to destroy everything regulatory wise, so we're going to let this suit stand. And then the White House said no. And so then while the implementation has basically been stayed on the current rule, the current administration is put out an ANPR and was reported the other day that they are in the midst of the Bureau running out of money by January, going to try to force a rule through between now and the end of the year. And one of the
ANPR is,
thank you, an advance notice of proposed rulemaking.
all right.
So
This is where
which
people get
is
to submit their comments and stuff, right?
well, yeah. So it's think of it as an early bite at the apple. So a normal rulemaking process. There's a rule proposed by the agency. As I see some of my former colleagues on this call, they will tell you there have to be economic studies about the impact of those rules, and there has to be a public notice and comment, and that's all dictated through the Administrative Procedures Act. An ANPR, an advance notice, basically gives an extra early bite at that apple and an opportunity for feedback. For the Bureau to finalize a new rule that could come out. So the original rule a year ago prohibited data providers, largely banks, from charging for access. Once that rule looked to be in peril, I think Chase put out their notice. The new rule that the new administration, if it were able to put out a rule, has said that that's going to be one of the things that they revisit. And it's just unclear if and when they would put one out, or if they would put one out through a process that goes through notice and comment. It wouldn't appear that they have time to go through notice and comment by the time they run out of money in January. And so one can only imagine if they put out a new rule and says banks can charge or whatever they say, they'll be sued immediately because it wouldn't have gone through the same public process.
Okay. I've heard argument from the bank that that liability and risk management was not adequately addressed in the rules.
So
what
I
is your
think
thought on
that was an early tension, right? You have safety and soundness rules that tell banks you need to keep customers' data safe and secure. And then at the same time, you had a rule that said you have to make this data available to anybody that has a valid authorization. And gave really left it to industry to determine how you would assess the validity of that authorization, and they left it up for banks to have an indicia of compliance or a way of suggesting when maybe it's not safe to say this person or entity representing Christiane isn't really who they say they are. But they didn't provide clarity on that. And so there was a crossroads. They also
Okay.
didn't um, specify when liability might shift from one entity to the other. But I would suggest that that's um, what we see if you look at like EFTA and electronic payments, basically the statute and what Congress said was that if a consumer has an issue with an electronic payment, they can go back to their account provider and assert that it was unauthorized or there was an error. What enables the institution to offload that liability onto a merchant or another entity are private network rules.
Right.
It's basically NACHA and the card network rules. So I'm not sure it would have. I'm not a lawyer. I just pretend to play one. It would have been a bit of a stretch, I think, for the Bureau in their authority. And they may have stretched their authority in many different ways, but it might have been a stretch for them to dictate when liability could be shifted between
Yeah.
firms.
And one thing I'd like to add, this actually brings in mind, conversation. At some point, I was invited to a NACHA subcommittee meeting, tagging along with one of the participants, and there were some advocates there who said, what we need is a really secure, safe, instant way to pay, and we have to invent it. I was like, well, there are a couple of networks that already do this. And I think, God bless all of our Congress people, right? But I think Congress has, and regulators has a way of perhaps oversimplifying sometimes, right? The question of liability shift, the question of who has responsibility, the question of where does the consumer go, the question of who bears the cost when there is a consumer problem, et cetera. Like those are complex problems. And to Gary's point, right, not only in the US, but in other markets, there have been networks, right, of, voluntary partners who have come together to say, we want to participate in the network. And in order to do so, we're going to agree to certain, rules, requirements, et cetera. But it's very complex. And that's why I really do feel like, putting something out very simply that says, consumers have a right to their data, that doesn't even begin to, tap into the complexity of, who authorized it, what is the data going to be used for, what happens when the consumer has a problem, et cetera. And so I think if we need government action to kind of open up the data, that's one thing. But I do think that all of the participants and the stakeholders who want access to that data and who have to give the data really do have to consider, the costs and the burden of complying with it. And so ultimately, I do think that there has to be some, cost transfer in this, because setting up a network where you have payments happening or transfers happening where all parties agree and have recourse, it's not a simple task. And if it were, we'd have many, many more networks. I feel like we have a lot, but I think we would have many, many more networks already.
Yeah. Well, that's interesting. Gary, first of all, I didn't realize the background that this happened in the middle of the mortgage crisis. I thought we were kind of just copying what the Europe did, the EU, but I guess it's a little more
That's why you
complicated.
hear Section 1033. It actually refers to one of the sections of Title
Dodd-Frank.
10 of the Dodd-Frank, and that's where it comes from. And the irony of all of this is that I think you could write a rule that just says consumers should be able to download their transaction histories in a CSV file, and that would probably satisfy the letter of what 1033
Yeah, and
says.
it's way simpler than what we're talking about
Yes,
here.
right. And everything else has emerged. And I just say one more thing, because I think Christiane made great points, is that let's be honest, open banking is already here and open finance is here. We have not had a rule stick or be in the books, and yet it's been around for 25 years. So just remember, like, this isn't like, oh, all of a sudden consumers won't be able to do anything. They can. The economics of it could change per this conversation and everything else. But meanwhile, while the Bureau is trying to write a rule and trying to, as you're suggesting, Deborah, think about like market evolution, what others have learned, and trying to incorporate that in there, we still have a functioning market. In the meantime, maybe one that's not as efficient as possible, but one that does function.
And it's really three separate functions we're talking about here: data access, liability, and consent. Where does that fall at the end of the day? And what are the mechanisms for making sure if there is a problem, who's liable and whose dollars on the line? Um, I don't think that, the initial rule set did a good job breaking out all three of those into one functioning group. Um, at least from my standpoint, it does say that the data should be made available. But right now we don't have a data standard in play. So whether that becomes useful in a portable fashion, which I think is the spirit of the rule, at least, the most recent example we can look to consumer rights like this is telecom, essentially. Everyone was locked into one provider because their telephone number was not portable from one to the other. And unlocking that increased a massive amount of competition in the marketplace. Um, whether, your account number versus your transaction data becomes a right, and the liabilities associated with each, I think should be codified, but right now it is very vague.
Right. Any other rebuttals, or should we go on to another question?
I mean, another consideration is unfair or deceptive use of the data by other parties, as well as unintentional leaks of customer data. Banks are generally held responsible for UDAP violations. That would have to be addressed. And then just generally, banks do have real liability and compliance costs, as you mentioned earlier, EFT, Reg E, Reg Z, risk guidance, etc. So providing the data is not free. Somehow somebody's paying for it.
Right. Now, my first reaction when I thought it was kind of shocking when JPMC came out with this, whenever it was, back in July or August. Now, David True, uncertainty hinders decisions. Wouldn't it have been better to have a set price assigned to data access so the fintechs would know how much to budget and the FIs would get some compensation?
Well, I mean, there are other use cases where financial institutions pay. For example, the credit bureau system, right? Consumers don't pay. All the data is in there. And if you're a financial provider and you want to make a loan, you pay for access. At the same time, consumers have rights. I know there was the Fair Credit Reporting Act that gave some, but for a while it was largely self-regulated. And the regulation has fine-tuned it, made it even better, giving people better rights. So there is precedent. I mean, there are others. I mean, we saw how Venmo kind of pushed the banks to come up with the Zelle real-time payment system that didn't exist before. I'm probably being too optimistic if I said the industry can figure out itself without any help, but it's possible to get there.
Yeah. Well, I'm reminded, since we're involved in all sorts of payments, that there are regulations that apply to ACH and wires and so forth.
Yeah.
But generally, credit cards, and to some extent debit cards, but mostly credit cards, there are very few regulations, but instead the networks came up with their own set of rules on how disputes and chargebacks and all that kind of fraud works. Of course,
I'm not with
yeah.
ACH, yeah.
Although there are those like merchants who think that they've been left out of discussion on how those rules were set. So I guess it's interesting having the industry do it versus having the government do it.
Well, one thing though to point out about ACH, right, is that ACH, I think one of the reasons that, the Fed operates, one of only two, is to provide competition, right? But to begin with, ACH networks were not government run, if my memory serves correctly. So I think, in a case where there's not competition, you can argue rightly or wrongly that the government should step in some way. But I think with the card networks, right, the private sector is there are options for card networks. Whether any of them have grown, discovered, just got bought, et cetera. Can you survive? That's a different question, I think. But I think, the government stepping in is a last resort, right? I think first the private sector should attempt to address it. And then if that, for some reason, there are deficiencies there, right, either from regulation or from becoming a provider itself, the government could determine what the rule needs to be.
Yeah, and there's
the card networks also own some of the aggregators. MasterCard owns Finicity. Visa owns Tink, though they did shut down their U.S. operations, and a couple of other. They both own international aggregators as well.
Yeah, I
But
think
that's through acquisition, I think, right? That wasn't
Correct.
necessarily
that's right.
inventing
That's right.
them.
I mean, and I'm sure somebody brighter than me on this call is probably going to come up with it, but I can't think of a situation in the US where a payment system is governed by federal regulation alone. I mean, we have checks, we have state UCCs, we have the card network rules, we have Notch, and we have Swift, we have all of those things. And really the regulation kind of sets the floor. You know, it is the private network rules that both embody the spirit of the regulation and then provide the tactical direction for how it works. What's fascinating about this situation are in almost every other payment system, it's always been bank to bank, a homogeneous participants. Even in the card networks, you have acquirers and processors sitting in front of the merchants, right? And then the other is that if it's payments, we can all talk about like the modern thievery, but either I have the dollar or Mark has the dollar, right? With the data, it can live in two different places at the same time. And we have fintechs who are financial services providers but aren't regulated currently in the same manner that banks are. And so it creates a lot of unevenness and a lot of challenge. In addition, I guess you could say this is like the early days of the debit card networks or ACH. As Mark pointed out, there's multiple aggregators, right? It's not like there's just one. There used to be multiple ACH operators, but a lot of that was all regional and geographically tied. Right now, we're at the point where we have two for redundancy between the Fed and the clearinghouse. So it's there's a lot of parallels, but there's a lot of things that make this a little pricklier, I think, than setting up a payment network.
So ultimately, let's remember that crypto initially was supposed to replace the payment network because the associations had a lock, and and why are we paying them 3% and we can make this all free? It didn't really happen because they're doing a little bit more than just charging interchange. So maybe they're getting too much, but they're also not doing nothing.
David, rather than me reading your chat, why don't you ask your question?
Not me.
Sure. Yes.
So part of this comes down to is role of government in my mind. So is the role of government to encourage innovation and competition? We know that public companies, just by their nature, particularly if they're listed, if they're stock companies, and particularly since Milton Friedman, only care about shareholder value. They don't care about helping competition. They don't care about innovation unless it helps their position. So is it the right role of the government to say, let's do something that will make competition, allow the private markets to work better? I mean, this being one of those that says, make the data available.
You'd like to hope so, but sometimes, it has unintended consequences. And especially if it's rushed, if you're trying to beat the budget running out, try and throw something out there, it has a knock-on effect.
Yeah, absolutely. But I mean, financial innovation led to 2008, and that had unintended consequences.
Yeah, that was very innovative.
Well, my point being that unintended consequences are common in a complex world, regardless of who makes the decision. So anyway, carry on.
One question I had is, well, it seems like a lot of the aggregators have come to some agreements with JPMC, but if they had balked, or because it seems to be so expensive, do you think there's any chance we'd end up with going back to screen scraping?
I have an interesting, I think consumers would rebel ultimately because I think inaccuracies, et cetera. I had an interesting situation where some of my offspring were trying to move money between different high yield savings accounts. And, the ones that were using the deposit verification versus the ones that were using, enrollment by Plaid or MX, et cetera, were immediately visible. So I think that, I don't think we'll go backwards. I think, as the parties have, they've reached some accommodation, in terms of what that price should be. I think that, it's no secret as a negotiating strategy, right, to start high, even if you'll end up somewhere lower than that. So I don't think we'll go back to screen scraping because I don't think I think the, kind of the consumer expectation has shifted way beyond that.
I mean, I can definitely from my standpoint, they're investing heavily in screen scraping across the board for
Really?
a number of reasons. One is the data sets that are available today and are regulated by 1033 are very small. It's just you're checking your savings, your credit accounts. Everybody wants wealth data. Everybody wants insurance data. There's a massive amount of data sets that are being unlocked by a new generation of scrapers. It's not yesterday's scrapers that are one by one being coded by individual teams. You have self-healing scrapers now coming online via AI. And so if you are going to start charging a massive amount of money for data access, people are already talking about and you can spin up scrapers on the fly, doing it for individual use cases. I know have fintechs that have built up scrapers for individual primary banks where either the coverage isn't there, or if they're going to be paying a ton of money to access one institution they need, they'll just go get the data point they need on their own. Outside of that, the rule set as it is today only codified institutions above $850 million in assets. So screen scraping still has to exist in its current form, as it is. I would much rather a world where screen scraping wasn't a thing for all the reasons that we are discussing here today, from security to resiliency and et cetera, but they are all investing heavily in screen scraping.
And
Yeah.
that's the market at work because there's consumer demand. I've never seen a consumer complain about something they thought was beneficial because they didn't like the way it was
Well, I remember
gotten.
back, it was like in the 90s when the screen scraping, it was very brittle because the bank could just move a field somewhere else on the screen and the screen scraper wouldn't work.
It's still there
So,
today. It's still very whack-a-mole today, but the
right,
new levels of technology coming online are
Yeah.
getting much better at avoiding that.
right.
And I think Mark's point is that's the market working. That's people saying, I want to provide this service. I have customers who will pay for it. I will get the information however I can.
Can I just put it back to the fintech industry? That there doesn't seem to be a standard for sharing data right now. I don't think so. So perhaps if the fintech industry proposed a standard that banks and large data providers like Fiserv, FIS, Jack Henry, if they work to that standard, and then you're telling the bank, look, if you meet this standard, then your customers are going to have a better experience with our products. And if you don't, then we're going to use a screen scraper anyway. So we'll still
There,
get data, but your customers won't be happy. And then there is, I mean, if you, I think we're all familiar with Intuit's Quicken products, right? Many small businesses use the product. They can either pull bank data directly from a bank or a participating bank, or you can export the information in their format. Now, banks actually pay to participate in that network, and you don't have to, but ultimately, if you're a bank and you don't, but the bank down the road does, someone says, look, I use Quicken. This other bank works well with it. Yours doesn't. So I'm taking my business away. So just right now, there's no standard for banks to work towards.
there is so
Um,
FTX is the body that the CFPB enshrined. They're a nonprofit lobbying group made up by the banks, the fintechs. Like on the board is Chase, is Plaid, is
uh,
everyone, and they've set a data standard called the FTX spec. We're also members of it, so we lobby on that data standard as well.
yeah.
We think there's some issues with it, but there is a data standard set by
uh,
the market and by the rule set
yeah.
already.
So that's basically a good it's a good starting point, basically,
Mhm.
right? Because
Essentially,
ultimately,
yeah.
if consumers find that they want to use your product, they want to use a fintech product, and it works better with Bank A than it does with Bank B, that will be a market driver.
Right. I think that's a big point. There's what the law or rule says and what the market says in being able to charge. And I'm not convinced that every bank that has the ability to charge for access will do so or do so in every use case in every situation. Exactly what you said. If think about on the business side where businesses might be providing access to their accounts to qualify for credit elsewhere. And if a bank were to shut that off because they want to be the creditor but can't match the terms or something, they run the risk of just losing the deposits altogether.
Yeah,
You get to a point where Chase is a big entity and responsible for what, over 10, 12% of all accounts And so all of the traffic, if you get down to the 20th largest bank, the tail starts to go like this, at least until you get to the Fiservs and Jack Henrys. They don't necessarily have the market leverage, and certainly not if all the banks, arguably, above them aren't charging for access. So there's going to be a few things that play out. The expectation to be able to leverage one's data has already been set in the marketplace.
So yeah,
At some
I
point,
had
it
that idea
becomes
too, that
silky.
some banks could say that they can advertise themselves as fintech friendly. If you want to use all of these apps, we make it really easy as opposed to the bigger banks who are putting barriers.
I think there's also some interesting considerations. Back to you raised the point, Deborah, about like the intersection of risk and the liability management and everything. I mean, under the model to date, an aggregator might have a data access agreement with a bank, but they're not a customer, they're not a vendor. They've just hey, we're just agreed to lay down a truce and say we're going to go through APIs, right? Once they start paying for access, they're a customer of the bank. And now you have KYC obligations from the bank on that aggregator. There's also points of leverage, perhaps, for the aggregators to provide services on behalf of the banks then when they're, paying or in lieu of paying and doing the risk management of the downstream data recipients to the specifications of the bank. So interestingly, we could see while the paying for access is a burden on the business models of aggregators, it could start to affect some clarity over responsibilities between players in the ecosystem.
Another idea I've heard, I don't know what you guys think about this, but this kind of stands in the category of the industry doing something, that there could be an accreditation body that looks at the fintechs and scores them for riskiness or certifies them for safety and soundness, or something almost like an insurance model, so that you could have tiered pricing, higher pricing for the more risky players. Does that sound like something that could be feasible or useful?
I mean, from a bank's perspective, you can't pay a bank enough to take on unreasonable risk. So there's no such thing. I guess if someone's considered risky, then a bank doesn't want to be doing business with them in the first place.
At all? Okay.
Yeah, I mean, there's no such thing as no risk. We all know that. But there might be other ways to price it based on the volume or something. I don't know. I think it should be priced based on actual cost, not making it a profit center. But
Oh, do you? Okay.
yeah.
And kind of going back to our original premise for this event was, does charging for API access, especially for money movement, make pay by bank less viable compared to credit cards? So are we kind of reconstituting the old interchange model under a new model, do you think?
Well, I think open banking is about so much more than pay by bank anyway. It's about being able to move your account. I remember in the past, banks would say, if you move your account to us, we'll transfer all your bill pay, all the entries. So being able to move those entries without having, if you're looking to take out a loan and your loan provider says, I'll give you better terms if you let me see your transaction data, that's something I would want as a consumer. So it's about, I think it's about a lot more than pay by bank. And in any event, I think real-time payments will probably eventually take that over. We're almost there. There's so many more banks are coming online every month. So we can't be more than a year or two away from being almost ubiquitous, and then also having the request for payments working. So we won't need pay by bank.
Yeah,
Okay.
We'll be down to real-time payment, I think.
out of my customer body, less than 5% is pure pay by bank. Almost everyone is, especially now, the latest wave, there's a lot of B2B use cases, automated accounting, LP suites, CFO suites, treasury suites. The problem is the data is not great. The plumbing is not great. I see a world where, like, honestly, if banks wanted to charge for the business access, those are very monetizable use cases where there's a lot of manual process today, whether it's collecting PDF statements to close a mortgage or fund a loan, doing that in a programmatic basis. It's the automated accounting of all the books and all these verticalized AI software systems we're seeing coming online. Um, I can see those, and that's not even covered by 1033 at the moment. If they want to make that the cost replacement center so that the consumers could get their data for free, I see that seeing a good compromise. But unfortunately, none of the banks are really thinking about this yet. And the business data tends to be the worst connectivity because the consumer was the big use case of the last decade.
Yep. But you're right. The B2B is probably the least touch and the most messy and could have the most benefit in the long run.
People are willing to pay for any lift over manual labor.
Yeah.
People are willing to pay for it.
And to your point, the only merchant I've seen really that we've seen, they haven't said anything, but they announced a pilot, was Walmart, because they're so focused on lowering interchange, but nobody else has really hopped on that bandwagon yet. Sorry, did I interrupt somebody?
No. I think it's all good points. I mean, I think number one, there is a lot of association of open banking and pay by bank, but they're two different things. And open banking can reduce the risk of pay by bank by verifying balances or things, but not remove all of the credit risk when it's going by ACH. And so it's kind of a merchant would have a decision on, what those trade-offs are. They're going to bear costs and risks one way or the other. And then also think about consumer need. But I agree with also what Mark was saying. In the sense that what's interesting is that if banks charge for access, again, in terms of maybe having clearer KYC obligations, one would expect another level of data accuracy to come for that, or you could pay a premium for all those things. So it provides, with a rule that says everything must be accurate and be free, there's no negotiation room. But, with another cut at this, we could see some kind of sliding scale there, perhaps. And I kind of shared your thoughts, Mark, too, in that I could see a new administration rationalize, well, if you do direct access, I go into my digital banking, my mobile banking app and want to access my data, banks could charge for mobile banking apps, but see how competitive that process would be.
Yeah.
But that's a little different than if I say I want to provide access directly to a third party for somebody that's going to be monitoring on a regular basis. And so um, there would be lots of, I think, different arguments to make for different use cases and what that pay scale might be.
I mean,
Okay, I
listen,
want to bring up
Oh.
one question. Sorry, Lou Morsberger, whether 1033 was or is a correct approach or not, fintechs and others build their businesses around the expectation of access at reasonable or no cost. With the rule disrupted and all the businesses now confronting the surprise of cost and or lack of access, can the private sector act quickly to restore some level of predictability, or are they just at the long-term mercy of the banks?
I mean, there's three entities that could be bearing the cost. There's the bank, there's the fintech, and then there's the consumer. And ultimately, I'm not saying the consumers have to pay, but that the fintech is monetizing some product. They're not doing this of the goodness of their heart. They're looking to make money somehow. So they should pay for it. I understand that JPMorgan came up with a new product with pricing, but that's something new. The screen scraping is still not free, but nobody's charging for it. Plaid charge for their services. So it's just a matter of who should pay. A reasonable cost, not any cost.
Right. I also think, right, ultimately somebody does pay for it, right? Yeah, and it's everything is wrapped into the price that ultimately the buyer pays for it, whether it's explicit or not, et cetera. So I think, if you think that explicit pricing is better and, the consumer should see how much it costs to get their data and they should decide if they want to pay for that, that's one approach. If you want the entities providing the service because they have the ability to charge for their service, that's another one. But nothing is like truly free, right? Somebody's incorporating it into their costs that they're charging someone else. So.
Yeah, I think the problem we just see at the end of the day from the fintech perspective is there is zero clarity. And actually, Chase's price to each of the aggregators contractually is different. And so now you're ending up in a world where Chase is cheaper on one aggregator, but Bank of America is going to be cheaper on another aggregator. And Citi is going to be cheaper on another aggregator, and trying to model out your input costs for a common user becomes impossible. And if you're running a thin margin business like an earned wage access product, where you're reliant on the data and you're serving customers who now, if you're not around, are going to go down the street to the check cashing place and pay an 80% interest rate at the end of the day, where the data is enabling a lot of that de-risking in the marketplace. And the problem is the sledgehammer approach. We're using the data access because any money is moving and there are like, it's no one can just sign up and gain access to this data today. You have to go through a KYC check, you have to go through a KYB check. The aggregators have data access agreement terms with the banks that they flow down to me that I have to flow down to my customers, including indemnifications, warrants, insurance policies, etc. So like that is written out today in some of the data access agreements. I just think that the approach where Chase is literally negotiating a different price per aggregator and is controlling the market to that level, and it's not just here's the price, open market. To me, it speaks to putting up barriers. And in some instances, Chase is motivated to have a more advantageous price with a partner they might be doing more business with in other areas of their bank. Whereas,
Right,
it
but
creates a lot of weird complexities.
And I think that's probably true, but I think that is nevertheless, right, in most things, that's how pricing works, right? I mean, there's a rack rate and there's what you can negotiate if you have volume or, good negotiators or other information or something to trade, et cetera. I mean, I think
In monetizable business lines, though, the defense that's being put here is recoup of cost. What is the cost of a unit if it's different from
well,
one institution to the next for the same item?
yeah,
I
right. And
mean,
I think I think there's a, I don't want to say philosophical, but right, you have to decide what category you put this in, right? Is it something that's, I'm going to say a basic need and therefore cost recovery is reasonable? Or is it something that's, those who have it, it's an asset and they should be able to, benefit from the fact that they spent a
Right.
lot to create this asset. So
Hey,
I have to answer that question first and then go from there.
Yeah, I
no,
think
it's the
that's correct.
question.
You look at it like electricity, where we basically said as a society, electricity is important for lots and lots of things. We're not going to let it be completely charged by wherever you live. It's regulated to some extent at a state level. Or is it, as Christiane said, I got good stuff, I'll charge you more for it.
Hey,
Because
Dean had a
the,
question.
yeah, okay, go ahead.
He said, fintechs, banks, and consumers, isn't this a classic US free market scenario where those participants will select the best outcome based on the value provided? But from what I heard, that
Right.
it's not quite that simple. What do you guys think?
I don't think anyone is saying it should be free. I don't think Mark said it should be free. You just don't like the way that Chase are maybe overcharging and you'd like better clarity and you feel they could give an unfair advantage to their partners. I mean, there are trust laws in this country. I don't know how far they go. I'm not going to tell you.
But
Not under
predictability.
this administration.
Yeah, right.
Well,
Okay.
that changes,
I also
but
think there is implied value that is not being dictated at all the market here, because I would love to know when my customer goes outside of my business and is using a product I could sell to them and what data they're using to empower it. And not only that, who are they using it for? Like
Yeah,
Chase
something that
knows.
never comes up.
Chase is going to know where they're getting loans outside of their bank for their customers. They're going to know what pay by bank services their customers are using. They're going to know what third party fintechs their customers are using. That is incredible intelligence to be able to bring in house and not have to try to farm externally, and to be able to cross sell your customers with what you have in the door already.
Yeah.
So there is a ton of implicit value also in standing up these
I'm gonna
APIs.
ask
There is, and I think it's, although I would say that's one that is underappreciated generally across the industry today and undercultivated, but I couldn't agree more with you on that. Look, there's a couple of other things, right? Chase could ask to be paid. We see this, like, what was it with YouTube and ESPN and Disney, right? At some point they agree, they're not going to agree. And I think this is another
right.
aspect of market permission, which is, what was Chase's BATNA if everybody said take a hike? They'd have to be able to either cut off their customers from access and use those things and risk losing those accounts, or be able to provide a direct access mechanism in response to that. And I don't know that many other institutions have that type of leverage or readiness. So that's going to come and impact. Just because we're seeing this here doesn't mean that it's going to explode across the marketplace. The other aspect of this is banks are increasingly data users themselves, right? And so, okay, you charge on one side, you're paying on the other, and maybe there's a way for some of this to neutralize out. There's a lot of points of leverage, I think, in here to help make this play out. I would agree with whether it was Nick or Christiane or whoever said this, like, I don't know that there's a clear and fast path forward to having some type of consistent pricing across the marketplace. But I do think it's probably a step towards that. If there's going to be any charging, it has to start somewhere.
Okay, and with that, I'm going to see if each one of you want to give a very, very short, like a 1-minute closing statement before we pop up the survey again. Or no. All right, Bill and Nikki, you want to pop up the voting again?
Oh, we want to do a closing
So you've
statement?
heard from banks arguing for sustainable risk-based pricing and fintechs arguing that they have complete uncertainty. So should
Yeah,
banks be allowed to charge for API access?
the question doesn't accurately reflect what we discussed, because it was not if they should charge, but how, and should it be centralized and the rest. So I'm going to leave it. Mine is undecided because it's not purely for or against.
If there's just one person who's undecided, then we know it's you, David. Let's see.
I
I'll
think there'll be a
make
few
it.
more.
I'll make a closing argument. In one respect, right? I think a lot of this is there's a philosophical yes or no, and then it becomes an amount. If the price that banks were charging was 0.0000000001 or whatever, come up with something that's non-zero, but negative, yes, there's an accounting obligation now that all entities have to go through. So there's a cost in the ecosystem for doing that, but is it prohibitive? So is the question really, should they be able to charge, or is the question, should they be able to charge at a certain level?
Profit from it instead of just recovering. Yeah.
Who's-
Okay, how do we look? Guys, how many answers do we have?
Only politicians, barbers, and taxi drivers have answers to all the world's problems.
Okay.
I'm going to steal that.
Okay, we have
It's a great
fewer
quote.
undecided. So before it was 44, and so we convinced a few people more that they should be able to charge for it. 24, we gained more points on the against, but they still didn't catch up with the 4. And the undecideds went from 31 to 21. I think that means it was a useful debate.
Exactly.
It made people make up their minds more. But thank you guys so much. This has been fantastic. And for everybody, just hang in there, and Bill and Nikki are going to assign us to various breakout rooms. Otherwise, we hope to see you. Make sure you join NYPAY.org and find out when our next events are going to be. Thank you, everybody.
Thank you.
Thank you.
Really appreciate it.